That drop in the Hang Seng, a reflection of the rest of the region as well, on the back of what Fed Powell said overnight. What's your take on it?
Sure, good morning. So the Fed's speech last night was obviously pretty comforting for the equity markets. I think people were expecting that maybe the Fed will come out and say that the rise in bond yields is sort of required and the economy is at full potential and therefore they may sort of lift off. But that was absolutely not what he said. And in fact, the Fed has made it extremely clear from last night's speech that they are going to remain accommodative. Powell was extremely clear that the U.S. economy is not operating at full potential at the moment, and that even if it did operate at full potential under the new monetary policy framework, it would still not warrant a liftoff until the Fed is absolutely clear that the U.S. economy is really running hot. So at the moment, from the equity market perspective, we think that the Fed has provided a lot of relief in terms of policy remaining supportive.
So, given those circumstances, Nupur, buy the dip? I mean, we are seeing the market broadening out. Perhaps it is a good opportunity to be buying now.
Yes, absolutely. So at Eastspring, we have been positive on risk assets, so equity versus bonds, for the last few months. We have predominantly been positioned in, particularly in deep cyclical sectors, the ones like industrials, materials, even financials to a large degree. They haven't really priced in the economic acceleration that we saw in the second half of last year. And so we think that that is really where the value is within the market, and that is how we're positioning ourselves. If you look at the fixed income space as well, we have seen credit spreads narrow, but we are still optimistic on high yield bonds, both in the US as well as in Asia. And we think that, monetary as well as fiscal policy support is going to help the credit spreads remain pretty narrow.
Nupur, just going to come to you in a second. We just got a couple of headlines just coming through from this Hong Kong budget delivered by Paul Chan. They're planning over 120 billion Hong Kong dollars worth of counter-cyclical measures. In other words, that is a sort of a relief measure, a stimulus measure, if you will. We're talking about, just shy of something in the region of about 1.9 billion US dollars. Tell me that, I mean, this is again important for this territory, as indeed is that $1.9 trillion relief package that Joe Biden's hoping to get through. As everybody does this, do we end up awash with liquidity, and how do we then ultimately, I suppose, go away from that? It's a bit like being addicted to a drug.
Yes, Rish. So fiscal policy, again, extremely important. The economies across the globe, not just in Asia, but in the US, there's not operating at full potential. The only reason you've seen sort of household disposable income remain intact and even grow last year is because policy has been supportive, and the market is absolutely relying on the fact that fiscal policy remains supportive. In fact, for us, the biggest risk that we see at Eastspring is that policymakers withdraw liquidity or fiscal policy support too fast. In terms of being addicted, to be honest, since GFC, we saw that monetary policy was, the market was very used to seeing easy monetary policy. In this crisis, fiscal policy has sort of joined the bandwagon, and it is going to be extremely difficult for policymakers to withdraw the support without causing any jitterness in the markets. From a medium-term perspective, we think that once the economies start to show signs of health, across the board and really show that different sectors in the economy can sustain themselves, that is when policymakers are going to start to gradually withdraw their support. But at the same time, as long as you see some amount of support from the policymakers, it's really the confidence that the market has in the policymakers which drives risk assets higher. So for us, for the rest of this year, we are really looking at a pretty bullish picture out here.
Nupur, I mean, we had Jay Powell saying that this rise that we've been seeing in Treasury yields is actually good news. It shows optimism about the economy. Does it really? Or, it could well do, but is it also perhaps factoring in inflation? Or is it, on the flip side of the coin, are people then looking at other asset classes instead to get involved with, where they can get better gains?
Sure. So I think the bond yield increase certainly reflects the fact that you are seeing the economy gaining strength. In fact, last year, In the second half, we actually thought that bond markets were the only ones which were appearing to be trading a little disconnected from the rest of the markets because it wasn't really pricing in the global acceleration in economic activity that we had seen. The bond yield, particularly if it's rising at the back end, so if you're looking at 10-year, 30-year Treasury yields versus, the 1-year or the 2-year Treasury yields, when the back end rises, it really shows you the confidence that the market has, on the economic growth. It is a sign of inflation, a repricing of inflation expectations upwards. But this is coming as a result of better economic growth. It's not coming as a result of stagflation, if you may call it that.